me start it. Hi, my name is Marek Niedźwiedź. First of all, Sebastian, thank you very much for inviting me to speak to your group. It's a great pleasure to be here, and I hope you're doing well in your home country, mate. You enjoy weather. We always speak about the weather in England for some reason, although the weather is just terrible. But this is the most spoken subject in England. So, but I'm sure you've got a great weather at this point. So yes, guys, today I'm going to speak about going public. Why to go public? How to go public? How much does it cost? And who can do it, to be honest. Just to clarify, I'm not going to speak about something called SPAC road. You may have heard about the SPACs. This is another great tool of going public and buy companies. However, this presentation is about slightly something different. If you want to know more about SPACs, I would suggest you reach out to Sebastian. He's got a great knowledge about SPACs. I'm going to speak about something slightly different. And another clarification, I'm going to speak about the stock exchange market in the United States, in New York, called OTC market. It's not NYSE or NASDAQ yet, because you can move from OTC to NASDAQ, for example, which is quite easy when you have when you meet some requirements by NASDAQ or NYSE. But OTC is kind of a junior market for small cap businesses. But you can Google it. It's more than 10,000 securities trading on the OTC market, so it's quite well-known market. Yeah, so before I start, let me just give you a little bit about myself as well. So again, my name is Marek Niedźwiedź. I live in Sheffield, England, along with my wife and 3 kids. Kids, actually, my daughter is actually 18, and she's just going to Oxford University, and my son is 14. So again, it's not a kid anymore. Clever boy, and another boy is actually 2 years old. Another clever boy. So as you can see, we did diversification. We did the diversification as well within the family, although quite challenging for at my age. Yeah, I'm an ex-military. When I left in 2003, exactly on the 1st of December 2003, I started my first business. I sold that business after 5-6 years to a large corporation. And at that time, I realized that you actually make money when you sell a business, not particularly when you run a business. So since that time, I started several other businesses. I acquired businesses. I had a few exits. And today I run I am the founder and CEO for AXA Capitals, a private equity fund specialized in investing in, co-investing or acquiring family-owned SMEs in the UK, in the US, and beyond, really. So just acquired some business in Portugal within the manufacturing sector. I do something in Poland as well, and aiming to do something in Italy. It's a bigger project. But today I'm going to speak about the US project, which is called AXA Software. We are a SaaS business going public. We're not publicly traded yet, so we're still under the process. However, I can share with you how that works. Okay, let me just double check my notes because I haven't got any slides, so I will be watching my notes here. Okay. So yeah, so why would you go public? Let me explain this by telling you a short story about 2 businesses. So you've got company A, you've got company B. They're starting out. They are in the same space, the same industry. They have similar resources, similar skills, quite similar businesses starting out. The company A is growing organically. Just as we know, you guys, some of you, I'm sure you run your businesses, so you know how it looks like from the beginning. And imagine after 7 years, so they grew organically, and they decided at some point they got some substance, they got some scale, and they want to scale up even in a larger scale. So they decided to go public. Obviously, once they publicly traded company, the magic happens. I will come back to it, what the magic is. Company B, the company B decided to go public in the first year, straight away. And it is possible, I will tell you how. So they went public in the year 1 or second year, and the magic happened. What is the magic? So first of all, I think the biggest advantage of going public is attracting talents. If you want to grow by acquisitions, you need skills, you need talents within your team. So obviously, as a publicly traded company, you can attract better talents. So they attracted a lot of great talents. Second thing, because of the publicly traded company, they had an access to a capital, easy access to capital, cheap capital, which means less risk, quick growth. The third thing is they win large clients. They will larger contracts because they have more credibility. They publicly listed, so they're growing much quicker. And the fourth thing is one of the advantages of going public is obviously mergers and acquisitions. The acquisition side, so you can raise money, or not just money, because being publicly traded company, I will come back to it later on, is giving you some tools, great tools to acquire businesses. And obviously, so they started to grow not organically, but also through acquisitions. So imagine those two businesses, the business A and the business B, after 7 years time, after 7 year time, what stage they are at, which one is larger, which one is far, is has a better, chance to, to be a bigger business, more profitable business. So it's clearly business B who started the journey from going public. And yeah, so I hope that explains you. So for example, attracting talent, again, I think this is the most important thing, apart from obviously raising access to capital. For example, my project, as I mentioned about, we have, I will tell you about that, slightly later on. We have a great team in place. I couldn't afford to have if we not have the story behind that we're going public, or we publicly traded company. But obviously our goals, goal and your goal, as I believe, is buying more businesses, doing mergers and acquisitions. Right. Okay. So very quickly, very shortly, because this is not, it's not about the quantum physics really. It's quite it sounds quite simplistic. How you can go public. Obviously, you may have heard that an average IPO costs about $2 or $3 million. So it's very costly process. Is available for larger companies. The biggest part of this cost is something called investment banking firm. This is the underwriter. When you do your IPO, you have to have the underwriter, which means the investment bankers. Obviously, they guarantee that you raise the money, But again, the cost of that is quite high, quite complex. It takes a year or 2 years usually. Um, However, the process we are going public is called direct listing. Some of you, I'm sure some of you may have heard about direct listing route or direct listing process. For example, in 2008, actually the first company that went that way, that road, was the company called Spotify in 2018. They went public without using the any investment banking. So so Spotify actually did the first direct listing, and after, since that time, there are many companies have gone through that way as well. It's a really game changer. The direct listing, the 2018, that was a really a huge game changer. And it's available for everybody. So again, the direct listing process, the main point is you're not using the underwriter, the investment banking firm. The second thing, you're not actually, when you become publicly traded company, you're not issuing new shares, and you're not raising any cash when you're becoming publicly. Actually, the money is raised during the process before. I will come back to it slightly later on. It may take 5 to 9 months. It depends on some, on different, various factors. But, I think you have to think about 9 months is the maximum time you can be publicly traded company on the OTC market, obviously, once again. So what are the requirements to actually go this direct listing route? So first of all, you have five requirements. The first is you have to, within your business, you have to have a 10% floating stock, which means you have to give away 10% of your common stock, the ordinary shares within your company, to shareholders, investors. So 10%. The second requirement is you have to have minimum 50 people, 50 investors, 50 shareholders within this 10% floating stock. So 50 people, 10% given away. The third requirement is, you have to be audited. The business has to be audited, but it's just technical thing. It depends on if you're actually starting up. The audit, within our company, we just very early stage startup. So the audit just takes 2 to 3 weeks. It's nothing to be audited really, and it costs just a few $1,000s really. The fourth requirement is you have to have operational business already. This business has to be operational. Again, we're not talking about SPACs, which is slightly different. This business ideally must be operational, which means it doesn't mean you have to have the revenue in place. No, as in our case scenario, we kind of created a what is our business model. So we have we just created the website, social media. We have the project. Actually, that was proposed by my partner from the US, within one of the shareholders, co-founders. He said, listen, Marek, you've got some great contacts back in Poland. There are some great SaaS businesses in Poland, but they all only exist in the Polish market. So why not helping them to actually become trading on the US market or English-speaking market? So that is our business model. So I created another brand which is called Synergify, and I've got some contacts. We've got we signed a few LOIs. So we've got some SaaS businesses in Poland, and they have some resources, capacity, and we will help them to grow in the United States. And this is our business model, but again, it doesn't mean you have to have the revenue already. So yeah, the fifth requirement, obviously you have to file with regulatory, which is called Securities and Exchange Commission in the United States. But again, this is quite technical thing. It's not that will be done by the third-party professional anyway. So again, 5 requirements: 10%, 50 shareholders, investors, operational business, filing with SEC, and with the audited accounts, obviously the audited business. And yeah, so just I will give you an example. So I mentioned about this operational side. So you have to be operational, but it doesn't mean you have to have the revenue. And the whole process costs about, it depends. It depends if you have your current business you want to take public, you can do it, obviously. It depends on the size, or the structure, the country of registration. The audit may be kind of more expensive, obviously, at that point. But the whole cost is about between $100,000 to $200,000 of going public. So, but to be honest, no, we're not spending any cash. No, I mean, it will not cost us anything really. Why? Because the idea is during the process, obviously, we have to find these 50 shareholders. So I decided to actually raise money. So find these 50 shareholders. Each shareholder is paying $6,000 for their part of the business. It's just kind of a ticket for this journey. To be honest, investing in a pre-IPO shares can be very, very profitable. So this is our story. Once we are publicly traded, obviously, the magic happens. The valuation can grow. We can, we will acquire businesses, so the valuation will just, blow up. So again, investing in pre-IPO shares can be very, very profitable. So we find these 50 investors, and we raise $300,000, which means the process doesn't cost us anything really. And to be honest, we've got some cash also for just for the future events if we need to. Obviously, there are some legal terms as well, quite important. I'm not going to give you any definitions here because you can Google it. It's not very important. You will use your third-party professional anyway. But just make you aware. This is about the regulations. You have to know about the regulation D, regulation CF, or regulation A. In the US, obviously, something called 506B, 506C. What documents you have to have in place when you when you approach these investors? So the term sheets, subscription agreement, bylaws, some PPMs, some others. There's quite a few documents, but again, you're not doing this by yourself anyway. And something called private placement, which means, during the process of going public, you cannot kind of advertise to the public, to everybody, invest in me. No, this is the restricted area. So actually, you can raise this cash, whatever it is. That could be 100,000, that could be 1 million. I know businesses they raise actually during the process they raise 2 million, 3 million as well. It depends on your network. So when I said this is not for everybody, but for most of you, I mean if you've got a good network of people interested, that people trust you and can invest in you. This is usually about the family, friends, raising money from family, friends, maybe your clients, maybe your suppliers. And if not, you can go raise money publicly. However, it has to be a accredited investor. The person called an accredited investor. This is the requirement. But so you have to pitch. If you need to pitch, you have to pitch to accredited investors rather than just advertise that you're going public. This is the private placement. But again, it's just a technical thing. So yeah, that's really it about the process. So again, I told you about the 5 requirements, the cost about 100 to 200,000 pounds, and some legal terms, some regulations you have to probably be aware, but it's not very relevant at this point. In terms of our, I mentioned again, for me, the biggest advantage of going public is attracting talents. Just let me tell you what happened, within my team at Axia Software. Again, we are this is a business based in US. We incorporated in Nevada. Nevada is great because it's probably the same like Delaware. However, there is slightly less cost in Nevada in terms of the tax. Yeah, in terms of the team I've got in place, I cannot imagine better team, to be honest. I cannot dream about. So in terms of investing, the investment side, I got a partner who is a ex a Wall Street guy. I know this Wall Street guy. Yes, he worked for two large investment funds in New York City. They raised hundreds of millions. They took companies public, Nasdaq, not just OTC but Nasdaq, the other markets as well. He was a partner for the for investment banking firm as well. So he's a very experienced guy. He's a partner and became a shareholder. I'm not aware about I'm not I haven't got any problem of giving shares away if the person is a high caliber person. I've got another investment guy actually based in Poland. He is a CEO and founder for quite not large, large in Poland. However, it's not very large. It's 1 billion market cap hedge fund and actually private equity, more private equity, but they hedge funding as well. January, it's a great guy. It's great to have him on board as well. Arthur, 20 years experience in software and NI, MBA in NI. He worked for large corporations within the software industry. So he brought this this software experience. I haven't got any experience in software in the software industry, to be honest. Robert is a digital executive. He worked for IBM, he worked for SAP, large corporations as a digital officer, 25 years experience. And we just actually decided to hire a CEO for, kind of full-time CEO for the business, because we more kind of a board, more shareholders. So we brought a CEO. And this guy is Los Angeles-based CEO. He worked for a CEO. He worked for Nasdaq-listed companies within the software industry, fintech software. It's a great. He actually created more than 1 billion in wealth in value for his shareholders. So this. Guys, you can attract those people when you have this story behind that. You're going public, you will be growing not organically but through acquisitions, and this is a great story, and so you can attract these people to your business. So I will answer the questions in a minute. Just let me maybe wrap up. So again, if you think about buying businesses, think about becoming publicly traded before or during the process, really. But you have to have some appealing story. Story is very important in the stock exchange. You have, you can actually consolidate maybe some, great industry. Maybe what they like is like all about the vegetarian diet, or about the all about the diversity, the sustainability is very sexy at this moment. If you have kind of an engineering industry, again, it depends on how you're going to tell your story. What is the story behind that? Okay, it's just an engineering business. It can be profitable, but again, it has to be some appealing story behind. So I think you should start from that point. Another thing is, you have to have some team probably in place already before you start attracting more talents. And remember these 5 requirements: 10%, 50 shareholders, operational business, doesn't mean revenue, audited business. Obviously, you will do the audit during the process, and SEC registered. And again, the cost is about $100,000 to $200,000. Depends, it must be more costly, but that is paid by your this ideally by your 50 investors that you have to bring into the business anyway during the process. And remember, the end goal is M&A. So ideally, before you go publicly, you publicly traded, you have this strategy, you have this business model already in place. You spoke to some businesses that you know that you're going to buy them, although you cannot actually sign any LOIs before you are Securities and Exchange Commission registered, because then you have to disclose that to the SEC, which is kind of again complicates the process. So ideally, once you're SEC registered, then you can actually start acquiring the businesses. You don't need to wait when you publicly traded. Although being publicly traded company opens more doors, it gives you more financial tools. For example, you can obviously just an ordinary way, you can just issue new shares and raise money, which I'm not a fan of it. You've got more creative ways, like you can do something called accretive acquisition, which simply means you bring profitable businesses into the group, and just you pay by shares, so you're not raising any cash, you're just issuing new shares and giving to the owner, and it's a tradable instrument. The owner can wait as you grow and sell more when you potentially move to NASDAQ and make more money really at that point. You can use, you can sell bonds, which is much easier, obviously, when you publicly traded, because investors trust you. You can raise something called preference shares. It's much easier to do. I like this tool really. There's something called extra bonds, which means again you're issuing bonds, which is the debt instrument, a very good debt based tradable instrument. However, again, you're not raising any cash. I'm happy to obviously speak about that, not today probably, because the tools are quite needs to be explained more in detail. So again, opens a lot of doors for acquisitions. This is why being publicly traded company is a great tool to buy quicker, more efficient, have more credibility to your buyers, to your sellers, and etc. etc. Again, if you're interested, I am more than happy. I can kind of help you. Reach me out, or you can probably if you want. We're still under the process of getting these 50 investors. Maybe you can just become one of our investors. $6,000 again is just the ticket for this journey. You can learn a lot from it as well, from our team. Great team. So yeah, thank you very much. Hope that was quite useful, and happy to answer some questions, guys. Let me just double check. Okay. So Ashwin, for these 50 shareholders, do they need to be US-based persons, or can they be overseas people as well? For example, 30 US shareholders, 20 overseas shareholders, thanks. Yeah, so no, it doesn't really matter. It matters, again, because it depends on what regulation. It's something called Regulation S as well during your private placement. But no, you can have, for example, I've got more UK-based people, people based in Poland as well, just a few people from the US. No, it matters, but it can be any person, really, to be honest. But again, you cannot pitch your investment story to non-accredited people that you don't know. You cannot advertise this publicly. This is the main point. So because that will be kind of that will be kind of checked by the SEC, and that would be a problem. So another question: operational business. What do you mean by no need revenue? I.e., a brand new company can be operational but zero revenue. How? Yeah. So operational business, again, it's ideally if you have a business and you want to take this business public, but if not, obviously I could do that. However, I've chosen, to go through, just to incorporate a brand new company. Operational, I mean by that, you have to have some business model in place. You have to have kind of a business plan. How you're going to make money? What is your revenue? What your revenue comes from? Again, remember, I created this project called Synergify, which means, we have our business model is we go to Poland, we help these Polish SaaS businesses grow into the English-speaking markets, and this is the model. This is this is kind of operational, operations we have in the business, and we have to clearly show that within our, private placement memorandum and other documents when we file when we actually approach investors, but also when we file with Security and Exchange Commissions. So again, it doesn't mean you have the revenue. Ideally, if you have one, or maybe you've got kind of, signed some letters of intents with your potential clients, like ourselves. We have a business in Warsaw, in Poland, where, a great a SaaS company, when, we signed a letter that, at some point we're going to help them to grow into the US market. But it doesn't mean anything really. It's not non-binding contract anyway. So yeah, it's kind of, you might have some social media just to show that you actually ready to, or you approach your first, clients. These shareholders, outsiders, UK, overseas, also need to be accredited for SEC purpose, same as you see. So again, you can raise your money. You cannot advertise publicly. Again, I'm not giving any legal advice here, so I'm not, my background is not legal. My background is more finance, but I know how it looks like. So you cannot advertise this publicly. You can approach, again, your family, friends, and your network. For example, your clients or your employees, people you work with. But if you want to go and publicly pitch to any people you don't know, then that must be an accredited investor. Obviously, there is slightly different definition in the US, in the UK, and I'm not sure about where are you from, but it's worth to check what that may mean in your country. And again, but that is more question to your legal team at some point. You cannot publicly advertise this. This is the most important. One more, what is the difference from a bond and extra bond? So just, a bond instrument is tradable, a debt instrument. So which means, I'm sure you know what bonds mean. Which means, you're issuing bonds and you raise cash, you just, however, the extra bonds is probably you cannot Google it, but I learned this from some other people. Clearly, I'm sure you aware when you buy a business, you can use a seller financing or vendor financing. Yeah, we do that quite often, and I cannot think about any deal within the small or medium size business without using any seller financing, because it's crazy. This is the risk for both parties, really. Small business is a huge risk, to be honest, when you acquire them. So a seller financing is kind of security for us as well. So issuing bonds is just ordinary bonds. You're issuing bonds, but you're not raising any cash, not selling those bonds to the investors. You actually giving those bonds to your to the business owner that you're buying a business from. So he's got these bonds, and what he can do with that? he can obviously, he gets obviously, for example, 5, whatever, 7%, 3%, whatever you promise every year, the coupon. And he can sell those bonds. He can, or he can wait when the bonds are, going back to us, or or there is something called call out. We can actually buy those bonds out from him. So not raising money, but you're giving the bonds to the seller. So the seller decides what to do with those bonds. So this is kind of a security. This is a like seller financing on steroids. It's more security for the seller, obviously, because another thing is very important within the extra bonds is obviously he has to open kind of the investment is called investments, or is investment bank account, yeah, because when you buy shares or you buy bonds, you have to open the investment bank account. And in his investment bank account, he can see, for example, the $1 million or pounds or whatever, in bonds. So he's got this money on his bank account. He cannot really spend it, but he can actually borrow some money against that security. It's a really great tool. So again, yeah, it's just another tool when you publicly list it. You can actually do that, without listing, but obviously the publicly listed companies, they give you more credibility to do that. Okay, guys, have you got any more questions? Hope that was useful. If I can be of help, you can reach me out on, you can Google, or you can actually put in here in comments. Sebastian, once again, thank you very much for inviting me here. Again, hope you're doing well, mate. And you're doing really great job here. Very, very good job. So yeah, thank you very much. All right, I will go. If I know how to. Okay, let me double check. Okay. Yeah, Sebastian, let's close. Yeah, we're still working on the hospital deal in Portugal. Yeah, right. Okay, bye-bye. Oh, I can see end live, so I'm going to end the live. Right, once again, thank you very much.